Okay, so this problem in my math deals with notes payable. Remember a couple of chapters ago we dealt with notes receivable. So notes payable is when we owe somebody else money. In this case, it's a bank. We're borrowing money from a bank here. And it wants us to calculate the maturity date of the note, and it wants us to accrue the interest that we owe at December 31st. And so I've got an example here that I'm going to go through. My example here is a little bit more detailed than what you have to do in my open math, but you'll be able to get what you need to do from here. So my example says on December 3rd, Excel Inc. borrows $20,500, 6% 90-day note to provide for working capital. So they're going to borrow this money from somebody, it doesn't matter who. It could be a bank, it could be an individual, at 6% interest, and it's a 90-day note. So as you know from prior videos, typically companies will produce financial statements at December 31st. So if we borrow this money at December 3rd, but we're not paying it back for 90 days, it'll be sometime in the next year when we're actually paying this $20,500 back plus the 6% interest. But we have to accrue the interest that we owe at December 31st, the financial statement date. Just like when we did the notes receivable, we had to accrue the interest that we had earned. This time we owe somebody else, so now we're going to be accruing the interest expense instead of interest revenue. But we have to calculate the maturity date of the note just like we did with notes receivable so that we know when the note matures, when are we going to owe this money back. And so you do just like you did with the notes receivable. You look at the month that the note was signed, you subtract the note date from the number of days there are in that month, which December has 31 days. We signed it on December 3rd. So we're going to take 31 days and we're going to subtract out 3 because the note was signed on December 3rd. And we're going to count 28 days for December. Then you just keep going until you get to the number of days in the note. So we've got 31 days in January. And again, we always assume 28 days in February. It's not a leap year unless the problem tells you it's a leap year. And I'm at 87. I need 90, so I need 3 more days to get me up to 90. So the maturity date of this note is going to be March 3rd. All right, and then my problem here asks us to record the journal entry that the company would need to make when they borrow the money on December 3rd. It doesn't have you do this in my open math, but I'm going to go through the journal entry anyway here. The journal entry, when we borrow the money, the people are going to give us the cash, so our cash is going to be increasing. Cash is an asset, so in order to increase an asset, we have to debit it. And we're going to put that notes payable on our books. Notes payable is a liability. Liabilities get increased with credits. So we're going to credit our notes payable for $20,500, showing that we owe this amount. Okay, and then the next requirement asks us to record the adjusting journal entry required at financial statement date, that December 31st, to accrue the interest that we owe, but we will not pay until December 3rd. Because remember, this is a 90-day note. So we're not going to pay any of this interest or the principal amount that's due until March 3rd. But we have to produce financial statements at December 31st, so we have to accrue any interest that we've earned and any interest that we owe. In this case, we're going to owe this interest, and we're going to owe 28 days worth of interest at December 31st because the note was signed on the 3rd, and there's 28 days between December 3rd and December 31st. So we're going to use that same formula that we used back a couple of chapters ago. Interest equals principal, principal times rate times time, expressed in the form of 360 days. And so in this case, our principal is $20,500. That's the amount we borrowed. Our rate is 6%. And we are accruing for 28 days, right? From December 3rd to December 31st. So our time is 28 divided by 360. So if we pull up the calculator, I'm going to work backwards in this formula. 28 divided by 360, times 6%, which turns into 0.06 when you convert that to a decimal, times 20,500 because that's the principal amount. So I owe $95.67 if I round to the nearest cent like the problem says. And so I owe this amount. And so I have to record this as an expense. Any amount that I owe or have incurred has to be recorded as an expense. So $95.67 is the amount that we calculated. And I have to show that I owe this. So I have to record some type of payable. Anytime we owe money, it's always some type of payable. In this case, it's interest that we owe, so we're going to call it interest payable. So expenses are costs that are incurred for the current accounting period, which happens to be this month of December, which is 28 days worth of interest that we calculated. And expenses get increased with debits. And then I have to show that I owe this interest. So it's going to be interest payable, $95.67. So at December 31st, when I prepare my financial statements, not only am I going to have this note payable of $20,500, I'm also going to have this interest payable showing that I owe this $95.67. So that's all that my math has you do, but I'm going to carry it one step forward and say, okay, now what would the journal entry be on March 3rd when I actually go to pay this note off? Okay, when I pay them the $20,500 plus the 90 days worth of interest that I owe them. So one of the first things we have to do is we have to calculate how much interest am I going to owe for the whole 90 days. So I'm just going to take that same formula that I had before, the principal times rate times time, and I'm just going to change this to 90 days because now I want to know how much interest do I owe for the whole 90 days so that when I pay them the money, I can write the check for the correct amount. And so if we do that in our calculator, 90 divided by 360, because we're calculating the interest for the whole 90-day note period now, times 6% times 20,500, I get $307.50. Okay, that's the amount that I'm going to owe them plus the principal amount of 20,500. So I know I'm going to write my check for the $307.50 plus the 20,500. Also, when I'm paying my liability off, I have to take this liability off my books because now I'm no longer going to owe that. In order to decrease a liability, you have to debit it. So all my debits and my journal entries come first. So I'm going to take that off my books now because now I'm going to pay it. I have to take this interest payable off my books now because I'm going to pay that too. I'm going to pay the whole 90 days worth of interest, which includes this $95.67. So I have to take this interest payable off of my books, because now I no longer owe that. Then I have to record the interest expense that I have incurred for the remainder of the note. Remember, I recorded the interest expense for December on December 31st, but I have these remaining 62 days from January 1 to March 3rd that I haven't recorded the interest expense for. So we have to do one more calculation here and calculate the interest for those 62 days. So I can take, again, the same formula, principal times rate times time, but now I only need to calculate 62 days because I'm only calculating the amount from January 1 to March 3rd. So 62 divided by 360 times 0.06 times 20,500 gives me $211.83. Okay, or I could have just subtracted the $95.67 from the total $307.50 and I'd come up with the same amount. So I know I'm going to record interest expense for the remaining interest that I have not recorded yet for January, and this represents the interest from January 1 to March 3rd. Because I recorded the interest expense for December already, but I have not recorded this cost that I've incurred from January 1 to March 3rd. And then the last thing I have to do is I have to write a check. Cash is an asset. In order to decrease cash, I have to credit it. And my check is going to be written for the $20,500 worth of principal plus the $307.50 that I owe for the whole 90 days worth of interest. Oops, got one too many zeros in there. So the last thing we have to do when we record a journal entry that has multiple debits and credits is make sure that my journal entry is in balance. If I add up the 20,500, 95.67, and 211.83, you can see down here Excel tells me that that adds up to 20,807.50, and I have 20,807.50 worth of credits. So my journal entry is in balance.